Well, welcome everyone to today's webinar. Today's webinar is, I think, the different or special in many dimensions. First of all, we're taking a deeper look into our new developments in the solution, where we take, as you will see, a much more detailed and granular view based on a realistic example of how to work within RGM, make price changes and other changes, and see what effects that has, and effectively do all that to improve profitability in the end. And I think during the time of this webinar, we do pretty much the equivalent of a full annual planning cycle across for one country category across different channels and so on. So really excited to do that. I brought my colleague Anton, who has been with us pretty much from the beginning and is now heading the product development. So really excited about that. He has also the slides. So today, first time for me, not a charge, no steering wheel here. And he will also show the demo and go to the details out of the beginning and come back then in the end. So really looking forward to it. Before we get started, just very briefly, who are we? If you haven't seen us before, we're at Buynomics. We're a producer of a SaaS, services, software as a service solution that helps our customers make better revenue growth management and pricing decisions. I won't go into the details because we'll have all of these details in the demo that we'll look at. To maybe get started and not to lose too much time or take too much time from the demo itself. Maybe if you go to the next slide, the idea is, and we do this quite frequently, ask people from the field what are their key topics, what's everyone on top of everyone's mind. And this summer, and I think this is still the case, top of mind for most is still inflation, deflation, how to deal with that, increasing, decreasing COGS, how that affects RGM decisions. That's also what we will focus on in this demo. We'll keep the intro very short. So this is really the example that we'll look at in this demo. And just to contrast, if you go to the next slide, with traditional solution, I think most of us who have actually worked or also for a longer period of time with changing costs are very familiar with the tool set that's available. I think the basic workhorse here is still the tool of price elasticity. And if this is really how you look at the reality, and you have a cost change, then I think it's on a very aggregated level, very straightforward how to deal with cost changes, because there's a clear relationship with price elasticity that you have in the market, the costs, and what is the optimal price. That's for if you have, for example, an exponential demand function, that means that you have constant price elasticity. Then essentially on the right side, you see this clear relationship between cost, price elasticity, and price. So the optimal price is just cost times price elasticity divided by price elasticity plus 1. Very simple example. Let's say your costs are 100 euros per unit, and you have a price elasticity of -2. That means the profit optimal price is 200. If your costs increased by 10%, go from 100 to 110, then your profit optimal price is 220. So, and that's specific to this exponential demand function. If you have, for example, a linear demand function, you would pass on half of the absolute price increase. So you would, if your costs go from 100 to 110, your profit optimal price would go from 200 to 205. So it really is important not just to know, or it's a reminder that it's important not just to know the price elasticity, but also the type of demand that you're looking at. And also it's important, as we see in this very simple example, that it's really with this elasticity framework difficult to also assess other options. For example, changing the size of a product, understanding the cross effects between different products. So when we increase the price here from 200 to 220, and we have also other products in our portfolio, it's of course important, but difficult to assess how these other products are affected by this price change. And this really also where in our experience, where traditional methods come to a certain limit in their usefulness. I think they're okay-ish to make rough assessments, but more difficult to use when you are looking for a very detailed understanding of a situation, which makes sense, of course, when lots of money is at stake and you're looking for an optimal response, for example, to a cost change. And this is really where we like to come in at Buynomics with the method that we developed that's really outlined here on this slide is. And we're happy if you're interested after the webinar, just reach out to go into more details on that. But really, in a nutshell, the core of our solution that's underneath our platform is the virtual shopper technology. And the idea is that the solution is based on a very large number of these virtual shoppers, tens of thousands, hundreds of thousands, depending on the context, each one with individual preferences. And together, all of these shoppers behave very closely to real shoppers. So you can show them any kind of change, a price change, as we had in the previous example, but also pack size changes. You can introduce new products. You can change the way you run promotions. You can delist products, and then you see how these shoppers react to these changes. And on this slide here, we have essentially very simple changes. You have 3 products, A, B, C, different sizes, different value to customer, different prices. And you see by the color here of these virtual shoppers at the bottom, what product they buy. And if you then, for example, change the price of the red product, product A, if you increase it, some of these red virtual shoppers will change their color because they might buy the blue or the green product, or might become gray and not buy anything at all. And if you do this, if you keep increasing the price, more and more of these shoppers move to different products. And this gives you on the right side the demand curve you see. And when you have the demand curve, you also have revenue and profit curves. And what we can't show on the slide, but what we can show in the solution, of course, is that these demand curves depend on each other. If product B increases price, then more people will buy product A, and it moves up the demand curve. And on the contrary, if you reduce the price of product B, then the demand curve from A moves to the right side, so demand gets less. And these are really things you can't show on the slides, these dynamics, but these are things that you can show in the tool. And that's, I think, when I hand over to Anton to look not just at a very simplistic case, but look at a more realistic case and see how working on that case with Buynomics is really the next step in RGM. I hand over to you.
Thanks, Ingo. Yeah, very excited, as I said at the beginning, to show finally Buynomics 2.0. We're going to do it a bit hands-on in a real case. So we're looking at something quite representable, what we see a lot with our clients, especially in the last months. So we're going to take a look at a FMCG company, global manufacturer, active across 3 categories: iced tea, soft drinks, and snacks. We're going to focus on iced tea here. And what the context is, the background, well, inflationary environment. I think all of you guys in the webinar have experienced that the last year and have dealt probably with similar problems. So we want to take a look on how to deal in such a challenge of COGS increases. So we're looking at a 5% COGS increase in the iced tea category, resulting in margins and profits being hit for our manufacturer here. And the challenge is really on how to win those profits back by pulling the different RGM levers. And I think that one's also not new, but what we're going to take a look at is how to put them together in the right combination at the right level. We're going to look at pricing, we're going to look at PPA, promotions, and combinations of those. And yeah, I'm very excited to demonstrate to you how that works in just a couple of minutes. A couple of words on Buynomics 2.0. So it comes with a reworked UI, reworked UX to our previous version. It's much more intuitive, it's much more user-friendly, and it helps you to deploy the AI. Ingo just talked about it, the virtual shoppers at scale. So you can really solve your RGM challenges across any type of scope, be it the entire US, be it across different countries, be it at a granular level where you want to maybe fine-tune on a retailer scale. You can steer those changes, you can evaluate those changes, the impact of those on all levels of granularity, which is here in the screenshot, and we'll take a deeper look in the tool as well. We added a management layer on that, and we've seen it a lot with our clients being very helpful on keeping control over what are the different levers that are being pulled, how much, what's the impact, because as Ingo already hinted on, they obviously impact one another. And the last one here, quickly to mention it, it's not changing to what we had before. So of course, the accurate predictions based on that one single source of truth, the virtual shoppers, are still there, but now being leveraged on a larger scale. That much on the slides. I am going to switch to the tool and I'm excited to take you through that. So as I mentioned, we reworked the UI a bit, we reworked the structure a bit. And before we go into the detailed case, I want to take a bit of a moment to demonstrate how the virtual shoppers work. That's really the fundamental on running the application, on running your simulations and being accurate in those. So here in the portfolio section, which is new, we have an easy overview of a portfolio with a couple of segments. And within those, we see our product list. So here we're looking at iced tea. Let me quickly sort that. So we have a couple of own products here. We have a couple of competitor products in the market. And these products are differing from one another in a couple of dimensions, whereas you can also see them value drivers, because those are the components what the virtual shoppers look at, and not just the virtual ones, but also the real ones when they make their purchase decisions. So here in this case, we have brands, we have a format, and we have a material, we have a pack size, and then some of these products are without sugar and so on. And behind these products, basically the virtual shoppers have willingness to pay for each one of those products, and even on a further level down on the different value drivers attributes. And how it works is when you show these virtual shoppers those products, they're making purchase decisions, and those ones are easily evaluatable. You can see within just a couple of clicks what the impact is. I would say let's start with a simple case, and then after that we'll go to the actual case study that we have. So here in this analytics section, you can really make all types of changes on your RGM levels. You can evaluate those changes. And what we're looking at here at the moment is our product list, the one that we just had before. And we're looking on our base scenario, and I already created a demo scenario. Nothing has changed yet. So for this case here, we see for the scenario, we have prices, we have the resulting units, there's an elasticities, revenue, and so on. You can put more KPIs behind those. And how those virtual shoppers work in essence is when you make a change, and I'm going to come to this in a second. As a teaser already, you can of course make all different types of changes here. So you can make your price changes, and we're going to start with that, but you can also make your promotion, product changes, trade term changes, really detail it out. You can differentiate that. We're also going to have a look at that a bit later and see the impact of doing that versus just a flat price increase. But to start simple, we're just going to advance to our product list. We see here our competitor products, our own products. And let's say we want to run a simple case, brand one, the first product, we're increasing it by 5%. We're applying that change. We're doing it for both the shelf price as well as the promotion price. And we quickly run that. What's happening here behind it, you see it on screen, virtual shoppers are taking the buying decisions. For each virtual shopper, there are millions behind this simulation. They're all making their purchase decisions on a most granular level. So they're evaluating the offer that is presented to them. It's the different products at the value drivers and the prices. And in each week, in each retailer, in each region, they're making those purchasing decisions. And what we can see from that is the resulting units. So we see here our product that we increased. So we increased the price, and we see an impact on the units. As expected, we're losing some sales, but they're not just going out, but they're being captured to some extent by competitor products. To some extent, they're being captured by our own products. And these dynamics here, those cross effects that Ingo just mentioned, they're very crucial on getting the dynamics right in such a simple case, but also in a much more advanced case when we're looking at not just one product being increased, but at multiple products being increased, maybe some PPA changes at the same time, there's maybe promotion changes. So all of these dynamics, they're rooted, or basically those dynamics need to be covered. And with the virtual shopper technology, they're just inherent to it. So it just comes out of the model that if you change a price, people make different decisions, they are confronted with a different offer. Maybe one word against or on the price elasticity. We see here the resulting price elasticity from the price change. I think we've mentioned it across several webinars. The ones who don't know us have already heard it. Just to reiterate, we're not working with elasticities as an input. So elasticities are the resulting output of the changes that are being made and the changes in purchasing decisions that virtual shoppers make. So if we see here an elasticity of 2.8, it doesn't mean it's static, but it's dynamic according to the respective environment of those changes. And to demonstrate that, I can quickly pull in another scenario. Let's say here, we're not the only one who's increasing it, but the competition maybe moves alongside. I can quickly pull in the scenario here. A scenario, by the way, is just a version of your offer, and you can create a limitless of those with just a few clicks. So we just pulled in another one. We see here on the average price, this is the scenario we had before. The demo scenario will increase by about 5%. In the new one, we increase by 10%. And the competition also moves alongside. We have some shifts in a bit of the demand. And just to emphasize the point I just made, units are changing. And of course, with that, also the elasticity is changing. This much on a simple case. I'm very excited now to look on how do you really work with this, because in practice, it's of course not as simple that you just have one product being increased. You have much more complex scenarios. And for that, we're going back to our case. So just to iterate that, we have a cost increase. We have prepared those scenarios so we can take those ones here out. We have a baseline scenario of before the cost increase. And we're going to take a look on the scenario, what that is, what that means for our profits. We're only going to work in the iced tea segment. We're interested in our own products at the moment. And I want to take a look on what that means. So here again, we're more in a more advanced case now. We see our own products. So I filtered out the competition ones. And we're looking on the cost for ourselves, which have, as stated in the case, they have increased. And here we're looking at profit, we're looking at margin. And we can see without making any changes yet, so we haven't touched any of our RGM levers yet, we see a significant hit on our profits here as well as on the margin. And now it's the question, how do we get those back? What are our options? And Buynomics really gives you the opportunity to do those changes in all different types of levers. So to do that, I'm going to quickly create a new scenario. Again, we see here on the scenario list, it's just a couple that we have created before, but you can create as many as you want. So let's create one that we call demo pricing test. We're going to start simple, and I'm going to pull those PPA levers in a bit later. I'm going to create that. I'll go back to this case and I'm going to pull it in. So I want to have my demo pricing test scenario in here, quickly add it to the scenario. And on this one, I can now make changes. And maybe a bit of more context, I think a lot of our clients, we see a lot with the people we're speaking with, preparing negotiations with their customers, which are then maybe taking place end of this year with effects early Q2. So for this case, let's consider we're negotiating some of those changes which come into effect early Q2. And as inflation is not just a topic that's for one company relevant, but really for the entire market, we can assume here that also the competition is hit by that. And well, we're not modeling the cost of competition, but we can model their reaction. And I think that's much more important for us. So we want to look at the full market, consider how maybe the competition also reacts. We're going to do one case here where competition is in a 5% increase, but we can of course do several others. Quickly on this one here again, so we see the different levers. We're going to start simple with the price change, but we'll see later if you run a product change, if you combine those, what the effect of those is. So if we run a price change, we're going to go in here. We have our different scope that we can select, so we can really differentiate across retailers. For now, we're going to do it in all. We're not going to do it for the full year. We're only going to do it starting Q2, but we're going to do that in both regions that we're offering. And then we can really differentiate our pricing here. So we see for now the competition. Let's focus on our own products first. And here we can do a flat increase. We can differentiate across the products, across the brands, across the promotion types on a detailed level. In this case, let's say we start with own brands. We're going to increase it by, let's say, 10%. The own brand 2, we know it's a bit more price sensitive, so we're not going to increase it that much. It's going to be a 5% increase. And own brand 3, we're going to put it somewhere in the middle. As I said, competition is probably expected to move along, and it's very important to consider that because, of course, their price level has an impact. So we're selecting just a flat increase for the competition, let's say a 5% increase. We're implying that, and with just a few clicks, we've created a new offer that we can test in the market. Virtual shoppers behind this are taking buying decisions. And for each one of those weeks, again, we saw it's the full year. So yeah, starting from Q2, across those different retailers, across those different regions, the virtual shoppers are taking buying decisions, and they're considering all of those new changes. So the new prices of the competition, as well as the new prices for our own products. So let's go back to our own products, and we see if we change here, maybe to a view where we're not interested in the impact anymore, but we're interested in the financial KPIs. We see basically the same thing. We have a bit of a reorg here of the KPIs. So we see our own products as before. We see the profit, and we see the revenue that we're making. And we have our initial scenario pre-cost increase. We have our base scenario just as before. And we have our demo scenario that I just created on the differentiated price increase. And what you can see here is that in a total, so we're looking at our own total here, we're actually recuperating a lot of those losses already. And just to do a simple view on what would have happened if we hadn't done a differentiated one, but maybe a flat one. So let's say we would have simply reacted like the competition with a 5% price increase on top as well. Well, that would have been not so good. You see here, it's about 3% difference on the profits. We're actually leaving real money on the table. So this much about pricing, but as I said, I want to take a look as well on the PPA part. I'm going to do the same thing here. We're going to create a new scenario. We're including the increase of the competition, because we're also expecting that. Creating a new scenario for PPA. And you see it's really just a couple of clicks, and you can create limited scenarios on those. You have your full list, you can order, you can structure it. And on this new case, I want to test first, how does it impact my market conditions, but then also, of course, how does it help me in recuperating those profits? So I'm looking at the whole iced tea segment. I'm looking here on basically nothing, and I'm changing the PPA, and I might be interested on the product view in the whole market. So what we're seeing here, we have our full product. We have our base scenario, and we have a demo PPA scenario here, already consider the increases of the competition. And now we're going to make this product change. And I think the product change is quite an interesting feature. So here again, we're only going to do it starting Q2, but it's quite a big difference. I think a lot of our clients have told us how much that helps them on gaining speeds, on really being much more accurate in their PPA decisions. You can, in essence, do any type of change here on your product portfolio. So if we do a simple one, let's say we're interested in our own products again, we're taking the first one here, the 6 times 1.15. You can just, with a couple of mouse clicks, test what does it mean if you change the material. We've seen it a lot on improving the packaging. What does it mean if you degram, maybe if you take some volume out? Well, we're going to do that here. So let's do a degramming by 5 milliliters. You can also do the pack sizes and so on. And we'll put that in the market. So virtual shoppers have now this new product here being available. And with this new product, they take into consideration of, am I maybe shifting to that? Am I staying at the old one as maybe another product becoming more relevant for me? And we've seen really with the clients that we've been working with that this reduces efforts that have been taking months before costly market research and so on. It's just a couple of clicks and you have your results. So here we see our new product. We see the one that we had before. And as expected, we're looking here on our units, our prices. And the units is really the interesting part here in this case. So we have, we're taking it out after the first quarter. We're losing, of course, a lot of sales on the old one, but this one is taking quite a bit of it. And what we just looked at in the very first simple case, you have it at the interactions on a small scale, but also here on a larger scale. So you see all of the interactions. So let's maybe take this one in here as well, because we're want to see how does that one help us in bringing back the profits. And if we do that, we see here again our profit manufacturer. We have the products with the new product. Again, this is without doing anything. Here we changed our pricing. Here we did just a flat pricing. So that one's not a good one. And just the PPA one is also not the one that really brings us back to it. But what Buynomics allows you to do is you can combine all of these changes. So without having the limit to just work in one silo, you can combine those. And if we pull in a scenario here where we do that, and of course we have prepared one of those where we have the degramming as well as the combination with the price change, you can quickly see, so we're still in the profit section, and we just added a new scenario. You can quickly see what the impact of that is. And as you see, it's not only better as the individual ones on a flat one or just launching it, but it's also better on the differentiated one. And this really gives you the option to fine-tune your whole portfolio. You can, with this, let's say that's our decision, you can say, that's what I'm going to go with to my retailers. I can fine-tune again my pricing and my trade terms to the retailers. We saw it before. I have the option here to really dive into detail. So I can look at all of these things. I can look at my retailers. I can take a look, how much am I selling maybe per week. I can group limitless on this and have then the option to really make those decisions on a more informed level. And with a view on the timing, I want to have 2 more short views on this before we switch back. So what I'm interested in is here I can deselect, I can look at my weeks, I can have those weeks, of course, being displayed. So it's easily to create any type of charts here, really limitless options. You can adapt those, you can pull in data, you can format those and then download them to share them. And one great thing to, if you don't only interested in going into detail, but want to zoom out, if you want to have your management views on that, what does it mean to, for my whole portfolio, maybe let's only look at the latest one. We have introduced the option of a dashboard. And this dashboard really gives our management teams so the option to have your most relevant KPIs at one view. You can pull in your views, your analysis that are most important for you. And with that, keep for one, a good overview on the impact that you're achieving, but also keep control on all the changes that are being done across those levels, across retailers and time. And with that, what we're very proud of having with Buynomics 2.0 now, we're helping our clients. We're happy to help you on digitizing the RGM process. So to sum up the case, sum up the demonstration here of the new platform, you can really, with just a couple of minutes, a couple of mouse clicks, optimize your RGM strategy on how much do you want to pull, where and when. You can combine it, you can dive in very detailed levels. And all of that is based on one single source of truth, which is necessary to get those dynamics right. With that, and taking a look at the time, we're almost running out. Going back to our presentation and looking quickly at the Q&A, Ingo.
Yeah, I think we'll just take one question. First of all, thank you so much, Anton. I think it was a really impressive presentation. I hope the audience also liked it. But also, as you pointed out, we already had with the time a bit. So I think that was also my fault in the beginning. Spoke a bit too much. So let's just take one question. So what are the virtual shoppers' behavior modeled on? Can we simulate different behaviors for the same scenario? I can probably also already answer this. So I would say most of the behaviors is based on real historical behavior, for example, or behavior that's taken from surveys. So it's really based on how real shoppers behave. There are some things or different scenarios can be created with different variations, so different preferences for different brands. For example, when you are introducing a new brand where you don't already know what the benefits are, or things like how people react to price thresholds, for example. So there are some variations that make sense that can also be taken into account as different scenarios. But I would say most of the behavior is based on historical or real behavior, and therefore that it doesn't make sense to really look at different scenarios. But the things that can be looked at in different scenarios can also be looked at in different scenarios. So with that, I think thanks again, everyone, for watching. Thanks, Anton, for giving us an overview of the solution. I think for us, so there was the Buynomics 2.0 webinar today. Next week, we have another Buynomics talk where we talk about pricing models and monetization with Alessandro Monti. The week after, we'll look into pricing methods. And then the week after, towards the end of October, we'll have another Buynomics talk more on behavioral features. So really looking forward to our next program. I wish that everyone hope that everyone had a very successful week. Wish a good weekend. Anton, good luck with all the weddings, and everyone else, looking forward to seeing you again in the next webinar. Thank you very much.